the Borrow Smart segment today, being brought to you by rsrdebtfree.com, rsrdebtfree.com. Let's see what we've got for us today. How to pay lower interest on a loan. Loans can help us achieve big goals like buying a car or going to college, but did you know that the interest rate on your loan can affect how much money you pay back? A lower interest rate means you pay less money over time in some instances. So, how can you get a lower rate? Here's some simple tips to help you save money. Number one, check your credit score and credit reports, cleanall3.com. We know this is obvious, but it needs to be said. Make sure that you are more familiar with your credit than any potential lender could be. This means checking your credit score and your credit reports, all three, because your lender will be looking at more than just your score. You may feel like you have a decent credit score and then be surprised by what rate your lender quotes you because there are too many negative items in your credit report. If you've never downloaded copies of your credit reports before, you can do so for free at the only official website, annualcreditreport.com. They will not give you scores, they give you your report. If you want more broken out view of your credit and explanations for what everything means, give me a call, 800-306-1990. But go to cleanall3.com to see what your scores are so you know what's meaningful there. Number two, and again, those are FICO scores, mortgage FICO scores. We're not interested in non-mortgage FICO scores or credit scores. Those don't matter. Number two, really spend time shopping around. Don't settle for the first loan offer you get. Don't settle for the second. The difference of 0.5% can mean thousands of dollars, so really take your time and do your research. Again, strategy beats rate always. Check the rates offered by your own bank, credit unions, digital lenders, mortgage brokers, anyone, to see who has the best strategy for you. Just remember to compare not only the interest rate, but also fees and charges that may be included. Number three, consider a cosigner. If you're having trouble getting approved for a loan or getting a low interest rate on your own, consider asking someone with good credit to co-sign the loan with you. Having a co-signer with a strong credit history can help you qualify for a lower interest rate. Number four, save up for a big down payment. Putting more money down up front can help you secure a lower interest rate on your loan. It shows lenders that you're serious about paying back the money you borrow. Plus, a larger down payment means you have a smaller loan amount, which can also lead to lower monthly payments and less interest paid over time. Strategically, though, there's price breaks, 20, 25, 30, 40, 50% down payments are where the price breaks are. So if you have 22% to put down 20 and ask the lender what 2% in points will do for you over the long run. Again, strategy beats rate always. Number five, choose a shorter loan term. The length of your loan term can affect your interest rate. Generally, shorter loan terms come with lower interest rates because the lender takes on less risk. While a shorter loan term means higher monthly payments, it also means you'll pay less in interest over the life of the loan. So if you can afford it, choosing a shorter loan term can help you save money in the long run. Saving money in the long run. But is that the best strategy? Maybe not. Maybe the strategy is you want to have the security of having a lower required payment, but you can always make a larger payment if you want to. Number six, improve your debt-to-income ratio. Lenders also consider your debt-to-income ratio when deciding your loan rate. This is the amount of money you owe each month compared to the amount of money you make. If you have a high debt-to-income ratio, lenders might see you as a higher risk and charge a higher interest rate. Paying down debt or increasing your income can help improve your debt-to-income ratio and might qualify you for a lower rate, or a different loan strategy. Ask about discounts. Some lenders offer discounts on low loan rates for things like setting up auto payments, having a checking account with them. It doesn't hurt to ask if there are any discounts or special offers available when you apply for a loan. Even a small discount can add up to big savings. Use mortgage points. That's a way to lower your interest rate by paying extra money up front to your lender. When you close on your mortgage, each point typically costs 1% of the total amount of the loan. So let's say you're getting a $200,000 mortgage, and the lender offers you the option to buy one mortgage point for $2,000. If you buy 1 point, you'd pay an extra $2,000 up front, but your lender might lower your interest rate by maybe 0.25%. If you plan to stay in the house for a long time, strategy. Buying mortgage points might be a good idea, strategy, because you could end up saving more money on your monthly payments. But remember, it's not always the right choice for everyone. Think about how long you plan to stay in the house and whether you'll actually save enough money in the long run to make up for the costs. These are just a few tips that you may not be getting when you go online to just fill out the application without talking to somebody who knows what they're doing. That's why I ask, give us a call. We'll give you a second opinion anytime. It doesn't cost a thing. That is the Borrow Smart segment, brought to you by rsrmoney.com, rsrmoney.com.